What's up, creatives? Welcome to the Tiffy Show. Today I'm going to be talking about how investing is different than saving. Now, if you haven't, make sure that you turn on notifications so that you know when I post a video. I like to post about dating, lifestyle, investing, travel, and everything in between. So if that's your jam, hit that subscribe button and let's get to it. Quick disclaimer before we get started, I am not a financial advisor. These are just my thoughts and opinions, so take them with a grain of salt. How is investing different than savings? To jump into this topic, I am going to break down what savings is, and then I'm going to go into what investing is. And a lot of people get the two mixed up and intertwined, but they are different. Now with savings, it's when you are saving your money. It's when you're putting money aside, maybe from a paycheck or a large amount of money that you get as a gift, and the purpose of it is a safety cushion. It's to use at a later time. Maybe it's for a future vacation or just your future in general, or a car, or just an emergency fund in case you need it. And that is savings. Now, with most savings, you put it in a low risk, high annual percentage yield bank account. There's not that many banks that give a high percentage interest rate anymore, so good luck in finding that. But I do find that if you go online, you can find better savings accounts to put your money in that do have a bit of a higher interest rate if you're interested in that. And back in the day, putting your money into a regular savings account was the way to go. You would grow your money, the interest rates were good, and you could just leave it in there, and the longer you left it in there, the more money you made. But nowadays, banks don't really give as many incentives for you to put your money into a bank account with them, other than a checking account. And I find that personally, there's really no difference than like putting it in a piggy bank or putting it in a shoebox under your bed. Don't look under my bed. There are other savings that are low risk that you can do, which are money market accounts or a CD, which is a certificate of deposit. Now, a money market account is quite like a savings account, but there is a minimum usually of the amount of money that you need to put into the account, and you don't have as much freedom with withdrawal. So you might have a certain number of times you can withdraw a month. Now, back in the day, money markets really competed against savings and getting you to put your money in them. But now I find that the interest rate on money markets and the interest rate on savings accounts, regular ones, is pretty equal. No matter what happens to a financial institution that is holding your money market, if they go under, you are still going to get your money no matter what. Now, a CD is a certificate of deposit, and it is another federally insured bank account, savings account. The difference, though, is that you are putting a fixed amount of money in at a fixed interest rate with a fixed maturity date, meaning that you can't touch it for a certain amount of time. Now, this time is usually between 3 months and 10 years. So in that time, you can't touch it, and if you do, you're usually hit with a fee. A CD has a maturity date, and the longer your money is in the CD, the more money you'll make with the interest rate. Now, remember that with the CD, you can't touch it. So if you need your money fast, if you need your money all the time, a CD is probably not the best bet in regards to savings. Now, let's get to investing. Investing is when you are investing your money or saving your money in assets that you hope will grow over time. Investments usually include stocks, bonds, mutual funds, ETFs, and real estate. Those are pretty much the main ones. I won't be talking about real estate as much just because it does take a lot of capital to get into real estate, but I can later down the line if that's something you want to do, because I have invested in real estate before. You can invest your money through brokerage websites like Fidelity or Robinhood. Those are the two I use. If you'd like to get started with Robinhood, you can click the link down below and check it out. It's very user-friendly if you're a beginner. I will say that. Like, it's super user-friendly and you can just jump right in and start investing your money. Now, you can also use a money manager, but I feel that you are smart enough to put the research in and grasp this so that you can have full control over your money and how you invest it. With this video and investing, I'm talking about long-term investing. So I'm not talking about swing trading, day trading, anything like that, which I will in later videos. This right here is just talking about not touching your money, letting it grow, and then in 10, 20 years down the line, you are going to be very, very happy when you open that account. And you're like, yes, I can retire, or I can be safe, or I can go on a trip, or whatever you want to do. So with investing, it's always a good idea to know that you're not going to be touching that money for about 3 to 5 years. So if you feel like you were going to need money, or you were the type of person that needs money all the time, and as I always say, know yourself, then investing might not be the best move for you to make right now. Remember, depending on which investment choice that you choose, it can be volatile. So I want you to know that it will take research, it will take learning, and not just jumping in, because that's where people really fall, is when they jump in without learning what they're doing and just taking a guess and that is when it becomes a gamble. So with my help, I'm here to help you. I hope to give you the tools needed or the tools that I use so that you can kind of form a plan yourself in regards to investing. To give you a simplified example of savings versus investing, I am going to tell you using money. So if you take $2,000 and you invest it into a savings account with a 3% annual interest rate, then in 20 years, you will have made $3,612, which is good. Any money is good money. If you took that same $2,000 and put it into a mutual fund with a 10% annual return, then at the end of 20 years, you would have $13,455. And that is a lot more than the 3,000 something I mentioned before. And that is pretty much in the clearest terms the difference between savings and investing. But remember that the investing does take more risk, but as you can see, there's more reward. Another thing to keep in mind is that with investing, you are pretty much beating inflation, whereas with savings, you're not. And that just basically means that the value of your money will decrease over time. And putting it into an investment will make sure that it doesn't decrease as much as if you were to put it straight into a savings. Inflation basically means that over time, the value of currency goes down. And what I mean by that is, if you think about it, buying a Snickers bar 10 years ago might have been $1, whereas buying a Snickers bar or a candy bar today might be $1.20. Or when your grandfather says when he bought a house, it was $25,000, and now buying a house is so much more. And that, my friends, is inflation. So by investing, you're beating that, whereas savings doesn't move fast enough for you to beat inflation. So which option is best for you? First and foremost, know yourself. If you need money, and you always need money for your children going to school or to fix the car, or you're buying a house, or any unexpected things, you always need money, then a savings is the best bet for you. But if you have money that you can store away for 3 to 5 years and not touch it, hopefully even more years than that, then you should look into investing. Now, I personally think that either way, whether you become a saver or an investor, I think that you should have an emergency fund. I'm not saying that you shouldn't have an emergency fund as an investor. Both of them, you should have some money set aside in case shit happens, because shit happens. I'm just saying that don't take all of your money and leave it in the savings. If you have more than enough money, put some of that into investing if you can, so that it can grow over time at the highest rate possible. Lastly, to make it even more simplified, when you think savings, I want you to think banks and low risk. And when you think investment, I want you to think everything else: stocks, bonds, mutual funds, and high risk. And that will help you separate what the two mean. That was generally the difference between savings and investing, or investings and savings. And I hope that it cleared up some things for you so you can figure out what you want to do with all that money that you have stored in that piggy bank. And if you enjoyed this video, make sure that you share, like, subscribe, and comment. Comment below and let me know if you're a saver or investor. And I will see you next time. Stay creative.